So what is a reasonable return, or what's a good investment return? Hey, I'm Hervin Pesa, I'm a financial planner, and in this video we'll talk about reasonable returns, returns expectations, and how these assumptions are used when planning for your investments and your personal goals. We'll bring back our case study from episode 2 so you can see how this is applied. This is episode 23 of 30 of our 2021 Money School. We've created a free mini course that takes you through all the basics of personal finance and investing. So if you find value in this lessons at all, please consider subscribing and hit the bell so you never miss any of them when we upload, and hit that like button so that it gives us love with the YouTube algorithm. So we know that in real life returns are quite variable, right? We know that there are averages, but there's some crazy ranges around these averages. So what's the point of using a return assumption or an average return if it's going to be wrong and there's going to be deviation as we actually invest? Look at this, for example. It's a known fact that the S&P 500 has averaged 10% long term. I've actually pulled up the index chart a few times. See, in this copy, from 1950 until June of 2021, the market has averaged 11.9%, which is astonishing. That's the historical average. But is that really what an investor gets? How average is the average? Let's look at this on a rolling annual basis. That's January 1950 to January 1951, February 1950 to February 1951, and so on. There's 800 plus instances that we can look at. There's an insane spread of outcomes. The biggest annual return is from July 1982 to July 1983, where the S&P returned 57%. On the other hand, the worst annual period ended in 1974, where it dropped 40% in a 12-month period. This tells me that any given year, the range of outcomes can fall between WTF and OMG. There's extreme and random deviations year over year and in a short term. So I pulled this data from macrotrends.net, highlighting the annual return of the S&P 500 from the Great Depression until 2021. I counted how many years the S&P was actually close to that average, giving it a window of 8% to 12%. So how often was it in this range? The annual return fell within this range 8 out of 93 times. Isn't that crazy? That's insane. So I increased the data range a little bit, and the window was opened from 6 to 14%. The frequency goes up to 18%. It was hard for me to grasp that, so just look at this visual. Again, this is from macrotrends.net. You can quickly see the variation visually here, but that's the same data set. It's just easier when you can see the bars of how far and how wide the range actually is on a yearly basis. So in the short term, our predictive ability is abysmal. It's hard to use averages that way, but we get slightly more accurate when we expand our view. Let's look at a 3-year or a 36-month rolling period. The ranges are still quite wide, with the high sitting at 34% and the low sitting at negative 15.7%. So let's push that out further at a 5-year window. With a 5-year period, it's even tighter, with the highest annualized return at 31% and lowest at negative 7.5%. But you and I are buy and hold investors, right? So let's push this out to the 10 and 20-year window. The maximum you can earn annualized historically on a 10-year window is a 22% annualized return and a negative of 5%. But if we push that out to a 20-year period, the lowest return is a positive at 4.6% annualized, which ended in March 2020. See, this reinforces the idea that, again, over a short period of time, we really don't know what's going to happen, and we have no inkling of what returns can be. Anyone that is pretending to know exactly what's going to happen next year or next month is selling you something. However, the longer we look, the more reasonable our average predictions can become. So you have to take this into context when you're looking at what a reasonable or a good return is. Now, that's the return for the purely equity portfolio. It seems like long-term, 10% seems kind of reasonable, right? But you know that adding fixed income instruments or bonds to your portfolio will dilute your returns when we talked about asset allocation in our earlier videos. Now, this does have an added benefit though of reducing or making your average window a little bit tighter, making it more predictable for you to look at your returns in a shorter time span. Let's look at historical dispersion for a balanced fund. This fund is broken down this way: 30% in US large cap, 30% in Canadian equities, 30% in bonds, and 10% in cash. Now, by the way, this asset allocation is not a recommendation, but it's what's available in this historical proxy as a balanced portfolio with this tool and this charting tool. With the pure S&P 500 position, even at the 10-year period, the worst outcome was still a negative 5% annualized. However, with the same data set provided, all 5-year rolling periods are positive. Yeah, the worst outcome is above 0. With that said, you need to understand that all these returns are from pure indexes. So it ignores transaction costs, fees, and MBRs. So you know that that's not really how real life works. So if we add a bit more realism to the averages, and let's say you paid an average of 1.5% in fees in all-in costs, the average return for the S&P 500 would actually still be about 10%. With a balanced portfolio, our diversified proxy, we're looking at a 8% return annualized. So we've looked at historical equity returns, and then we've looked at a more diversified portfolio, and we've even taken off the fees. So is that actually what you're likely to get? Probably not. See, Morningstar published their 2020 Mind the Gap report. It's an annual report where they highlight and they show what investors get versus what the funds are getting, the ones that they're actually investing in. They highlighted that the average investor earned an average return of 7.7%, while the same ETFs and the same mutual funds that these investors were using, those brought back a 9.4% return, which is pretty close to our average, right? But this behavior gap is also supported by long-standing research by Dalbar. The most recent update for the first half of 2021 shows that the average investor trailed their actual investments by 2.11%. So let's say you would actually trail your investments by about 1.5%. Again, there's what the markets and investment returns bring, and there's what the investor actually gets. So if you're keeping up, we took off 1.5% for fees, and then it's probably reasonable to take off another 1.5% from misbehavior. Buying high and selling low out of fear and greed. That's really what that accounts for. So now all of a sudden the 10% that everyone spews when they're making their rosy projections gets dropped to 7%. But by the way, if we're using the actual average fees that Canadians are paying, which is over 2%, and the volatility increasing misbehavior, this would actually be closer to a 2% reduction. So why are return assumptions then so important? We did so much adjusting for historical and what we're actually going to be expecting, or we're going to be plugging into our calculations. That whittled down expected returns, right? So let's put this into practice now. When we create financial plans, the assumptions we use will have a massive impact on our recommendations or your actions if you're doing this for yourself. See, using annually variable plans makes our savings targets impossible to understand. We may even use Monte Carlo simulations to stress test plans or returns, but rebuilding a financial plan for every slight change in the market is just impractical for planners, but it would also destroy any desire for clients or investors to look forward, because they'll be paralyzed by all the changes. That's going to be impossible for most people. So instead, we use these average returns and expectations to come up with savings rates. How much our clients would actually need to set aside today to meet their financial goals and funding requirements by the time they retire or when they need the capital. See, I always look at the consequences of being wrong, because for me, it's personal. I'm 29, so it's very likely that I'll be in this profession for a while, and I want to see the outcomes of the plans I create. I'll be there to see whether we did good or not. There's two main risks that I look at when creating financial projections. If I'm too conservative and I use low investment returns, for example, this would mean a higher savings rate, and the clients or you would have to give up more of your lifestyle today. If the returns end up higher, this is the final outcome. You gave up more than you needed to today, but you'll have a more lavish life than you aim for in retirement, or you'll have more to fund your long-term goal. Now, on the other hand, if the return assumption was too lofty, let's say I listen to these TikTok posts saying 10% per year is reasonable, which by the way, it is if you're in a pure equity and you withstood the volatility that comes with it. But the moment you factor in being human and the fees we pay, all of a sudden, that 10% doesn't look like it's reasonable. See, in this case, if I use that lofty return, the ultimate consequence of being wrong means you won't have enough money to hit your goal, or you'll run out of money and spend the last few years of your life destitute. So there's a risk of saving too much and the risk of not saving enough. Let's talk about Vicky and Sam again from our video 2 case studies. We had 2 return assumptions that we used for that illustration in that case study. There was the pre-retirement return and the post-retirement return. We'll focus more on the accumulation phase of this scenario. Remember that they have $180,000 saved right now, and they have 25 years to keep saving until they get to retirement. Their funding target was anywhere from $1.3 million to $1.4 million, depending on where they actually saved the cash. We said that they could set aside $925 every month combined as a household, and we assumed a a 6% return. If that was the case and they actually got that return, they would hit that funding target of 1.4 million bucks. But let's say we were wrong. We were wrong in two different ways. What if the long-term average return was actually higher than what we projected? And second, what if the long-term return was actually lower than what we were projected? Let's look at the first scenario first. What if they got 7% as an average return instead of 6%? All they would actually need to save is $540 every month instead of $925. Because of our conservative plan, they were putting an extra $400 monthly that they could have utilized for enjoyment or fun or living today to create memories. See, this error would have meant saving more than they needed to and taking away from their life today, and they'll have more money than they need in the long term. So that's a consequence, right? But what if we were wrong and they got a 5% return annualized instead? They would miss their funding mark and get to 1.15 million, which, by the way, that's still a lot of money. But if you didn't understand what they were targeting before, this ultimately means they're going to end up either retiring 2 years later or running out of money at 84, 6 years sooner than their life expectancy, spending the last 6 years of their projected life reliant on government pensions alone. So I hope this shows you how important, how much care we have to put into using return assumptions. Lean too much one way and you can deprive yourself of living in dollars today. Get too exuberant or lofty with your return expectation and you'd end up with less than a desired lifestyle in the future. Of course, this is also a factor of life expectancy, but whenever I ask my clients which risk they'd rather take, most would choose the risk of saving too much and having more money than they needed compared to missing retirement targets or running out of money in retirement. All right, I just want to share one more piece of information as far as creating return assumptions. FP Canada publishes a guideline every year for the projections that we use, and they kind of show what's a reasonable return. So even though 6% or more is reasonable, right? Like based on the historical returns that we just addressed, the plans we create actually get stress tested at a much lower rate. The published guideline intends to protect clients from the biases of CFP professionals creating the plan. It also creates a standardized guide for clients so that it's easy for them to understand why returns are being adjusted down. Here's the current breakdown. You'll be surprised that the nominal return assumptions are much lower than what you might assume. The Canadian equity is projected at 6.2% per year before fees. Foreign developed equities, which is the US, at 6.6%, and emerging markets at 7.8%. Fixed income at 2.7%. We would then create a weighted return projection based on the portfolio we construct. Let's say that the breakdown is a 65-35 with the following breakdown: 25% Canadian, 10% US, 10% emerging, and 30% fixed income and 5% short term. Following the guide and after taking off the fees, the assumed return for this plan then would project at 4.14%. I'll link the FP Canada guide below so you can see what they're using as assumptions and how these are calculated so that you can understand them for yourself. If that seems too low and it's too harsh for the assumptions, please remember that the S&P 500, even though the average long term was at 11, the last 20-year period actually ended up at 7.5%, much lower than the long-term average. I hope this highlights why you need to use assumed returns and why we have to be careful about the assumptions we use as investors. Tomorrow we'll have another video for you taking you further in your investment education. Until then, stay aware, take control. I love y'all. Bye. Check yesterday's video about passive and active investing over here. Check the whole playlist over here and be sure to subscribe. By the way, click that like button.